Guys, it's time to start the panel. We are no longer in panic mode, but the government appears to be done dwindling with bailout money, and seemingly our census has not been come up yet. So my first question to the panelists, and I'll start with Alan because
I'm the oldest.
You're the oldest, are you?
Yeah.
Yes, you are. What is your outlook on the industry and the acquisition market for this coming year? And what are you expecting in the near future?
So our outlook on the coming year is that we see more and more M&A activity. People that are not able to recover their census will need to talk to Ari to sell their building. And then Ari will talk to all of us to finance it. But it's a very good industry because the United States needs the nursing home industry. This is the cheapest place to take care of residents that are frail and elderly and they need the help. It's just going to take time. People have to be patient. And you have to be focused on your numbers and focused on your relationships and your outcomes with your hospitals. And I think that's where this industry goes over the next 12 to 18 months. It's patience. It's being consistent and being a good listener to the hospitals and helping them with what they need to create the outcomes for the resident.
Erik?
Yeah, excuse me, I agree. I think we're going to continue to see the consolidation. It's been obviously part of everything we've been doing for the last 12 to 24 to 36 months. I think it's been obvious. We've seen what I refer to as diseconomies of scale, too big. Healthcare is a local business. We all know it at the end of the day. As Alan noted, it's outcome driven, it's relationship driven, it's care driven, it's reputation driven. So I think that while there was tremendous activity last year, even still, those deals probably started in 2019. There were pockets of facilities that weren't as impacted by COVID, and so we're able to continue to transact last year. I think that coming out of PDPM and the sophistication that's clearly required day in and day out, clinical complex residents, obviously, that we all deal with, I think there's going to be continued consolidation from smaller operators that COVID was the straw that broke the camel's back. And so to the extent that we haven't seen those facilities trade this year, I think as Alan noted, we're waiting for occupancy recoveries. But I think the consolidation trend absolutely continues for the next 12 to 24 months at a minimum.
Amy?
I hate to agree with them, but I do.
Okay.
No, I think what we've seen and continue to see is the larger operators who are divesting of properties into regional businesses and are being acquired by smaller operators, regional operators. And then we've seen the mom and pops or the not-for-profits who realized that they couldn't survive in a COVID environment and that they need to really not be in the business where you need the resources, the infrastructure, you need the clinical coordinators, and the sophistication that comes with being larger or smaller, but bigger isn't always better, and being one-off is not always being better. So I think we're going to continue to see more divestitures and regional focus.
Ari?
I think a lot of the acquisition activity in 2021 and probably going into 2022 is going to be similar to what we saw in 2020, which is the REITs that have had bad exposures in the nursing home industry and the SNF space continuing to divest. I also think that as we come to the end of people being able to utilize the stimulus dollars that they've gotten and the PPP dollars, I think a lot of the acquisition activity are going to come from the folks that thought that they're going to be able to make it pass, and now they're running out and they're hitting the end of the line, and now they just don't have a choice other than to sell.
Again, so I guess this is really a question for Ari, because as a buyer, we're hearing about all the horror stories of, big, large operators going out of business and being bankrupt and whatnot, but yet every day our inbox is flooded with deals in Clumperton, Oklahoma that are selling for $250,000 a bed. So there's kind of a contradictory situation here, is because from the news it seems to be grim and like very, very, like the landscape is going the other way, but the bed pricing is not reflecting that. And is there any way that you could explain that besides for obviously your team driving up the prices?
I would actually hit back on you on that point and say I think that that's a common misconception. I mean, if you look at the states that have struggled historically and how they've coming out of Corona, I mean, you have states like Massachusetts and Wisconsin that continue to shut down facilities, Ohio who continues to shut down facilities. I mean, I think this just exposed problems that were already within the industry that, you know, with a problem like the pandemic that no one expected, that people just can't get out of. But in those particular states and in other states like that, purchase prices have plummeted on a per bed basis. I mean, even as recently as before Corona, we were transacting in Mass at, you know, 60,000 a bed, 70,000 a bed. I think we're seeing prices come down over there. And even in a state like New Jersey, where prices had started getting run up to the 150s, 160s, if you look at the majority of the transactions that have been done in that state in the last, 12 months, it's been more in the 115 or 120,000. I think people confuse the activity in the market with the per bed prices. Now, there are states that before Corona and through Corona have been very, very strong CMI states, which help operators do better when you have complex patients, with Corona and other issues that they're coming in with. And I think those states, if anything, have remained strong and have gone up, but I think those states probably in the normal course of business would have continued driving up the per bed prices anyway. So I actually don't necessarily see, I think the surprise is the activity, not so much the per bed prices.
Alan, Amy, Eric?
Well, I think, and I know I speak for Alan, I don't know if I speak for you, Eric, but lenders over here like to maintain our per bed discipline, as we've told you. And so I think we're
Not
really...
Eric. Okay,
so I think really it is maintaining an understanding of ultimately what we think the assets are worth. And in certain states, to Ari's point, yes, you can go higher. They are worth more. You've got strong CONs, what have you. But you really have to maintain your discipline, because as a lender, you want to make sure that ultimately, if something goes wrong, that you have an appropriate basis. Because when things are well, yes, you can justify and support a higher value. But when things go bad, it's all you have.
I think a lot of it goes down to the operator. If the operator has a deep bench, has tactics, technology, knows what they're doing, they could actually pay a little bit more because they could grind a little bit more out of it than someone who might not have the ability or capability or team. Who has the team? I think the team brings the value to the bed price. So that if you have a really good team, you could actually pay a little more because you could leverage off of your hospital relationships, leverage off your technology to make that worth it to you as an investor. Buyers of nursing homes are investors. They're buying assets to make a return. They're not in it. They're not a voluntary. They're in it to make money. So to make a 20, 30% equity return, they have to be able to see vision to that, and I think that takes the team.
Welcome, Ralph, by the way. Thank you. You missed my line about you getting 65 bips no matter what happens. Oh, yeah, I'm glad I missed it. 3 years ago, we were sitting in this room, and I was sitting in the audience, and I heard Alan say, you know what? For years, everyone said, stay away from Ohio. And now everyone's running to Ohio. And I said, oh, Ohio, everyone's running there. I got to get to Ohio. And that's literally what motivated me to buy in Ohio, stupidly or not, because of that one line that you said. What advice can you give to the audience today that's sitting here right now, waiting, wondering, thinking where we should be buying next? Alan.
So I made the prediction of Ohio 3 years ago. I think it's a little harder now. We're seeing what's going on in New York with the regulatory environment and how it's all a political football game. The nursing home industry got involved in politics. So I think we're looking at is the demographic shifts, the population shifts, and where there's strong budgets and there's a good system of reimbursement in the CON. And, everybody says, do you lend in North Dakota? We say, I don't really know where that is. And, I didn't do well in class and that stuff. And so we try to lend where there are people and you all have access to technology now that'll show you where the demographics are. And the hospital systems are publishing a lot of data now that's readily available that'll help you see what they have issues with on outcomes. And as an operator, if you have the team and the tactics, you should be able to track the hospitals that are producing the discharges, that are producing the outcomes that you think you could solve. That's where you go. It's all data-driven now. The hospitals provide everybody in this industry what's going on. The federal government's demanding it. And if you mine into that data, you could find out exactly where to go.
Erik, anywhere that you would suggest not to go?
You know, it's hard. I think part of the challenge is that the regulatory environment, the budget environment can change every year, every 2 years, depending on elections. We've seen that. So clearly, there's very strong states in the Mid-Atlantic and the Southeast that have high barriers to entry with certificate of needs. It's obviously the old supply and demand. So, I mean, to the extent that you've got a few nursing homes and insatiable appetite for those markets, you get higher per bed prices. So it is challenging to look and to try and figure out where the next Ohio is going to be or where the next Maryland's going to be. I think Alan's absolutely right. I mean, intuitively, you think about states like North Dakota, South Dakota, those types of environments where the population's just challenged, unfortunately. So, but good operators can make money anywhere, as you all do, Freddie, in Illinois and other places. So, I think the landscape of having a state and regulatory bodies, Department of Health, that's supportive of the industry and has historically been supportive of the industry. Clearly, as we've mentioned, there's been challenges in the Northeast and their adverse reaction to facilities and facility operators. So it's hard, but again, I think there's opportunities in many states. Just to Alan's point, you got to pick your spot.
So Freddie, interesting point. You went to Ohio, and the state now has come out saying they want to close, out of the 978, they want to close 100 nursing homes and pay you 10,000, God forbid, but pay you or someone like you 10,000.
Yeah, but I paid 75.
Correct. So that could be but then it might actually be a good idea to go to Ohio because there'll be less beds out there. And if you're a good operator and you have a good team and you can provide good care and you could provide good coordination with the hospital or an ACO, whoever you're coordinating with, maybe there is an opportunity there.
Well, I wouldn't advise that for anybody in the audience. But, yeah.
But if you're going to go to Ohio, partner with Freddie, and you'll be fine.
Ohio's a terrible state. Anyway, what would we, Alan just mentioned it, but this Cuomo, the 5% profitability cap. And, we've seen, different versions of this in bluer states. But A, how is this going to impact the industry? How are the banks looking at it from a lender's perspective? It's a very, very scary thought of, the government capping us and saying, you can only make this and this much profit, but not really providing a floor saying you could only lose this and this much because we're not underwriting the losses, which is how I'm understanding the rule. It's basically you could lose millions of dollars, but you could only make 5%. So how are the lenders reacting to that? Amy?
I think it's a little early because I don't know that it's really going to play out as suggested. I also think...
But it has passed into law, right? Yes. It has passed into law, yeah.
So, okay. I don't have a lot in New York right now, so I don't have a lot of firsthand knowledge. But what I can say is, there are lots of ways without going afoul of the government to ensure that you can make money in other ways. And so, I think that smart people will find ways to make these facilities profitable. But if not, they'll find that people don't want to own nursing homes there, and they're not going to have the intended outcome because if they get the people who just want to go at it for at most a 5% profit, it'll probably bring down the quality of care.
Ari?
I mean, this is a cyclical business, and whatever the triggers are for creating ups and downs in the industry, I mean, fundamentally, it's always going to come back that you're going to have ups and downs in the industry. I think what's been exposed to the industry, and I think what we're all trying to get better at, is that so much of our reimbursement is tied to government, but I don't think we've ever truly played the political game correctly and had representation at the state level and at the federal level to the extent that we have today. So I think that playing out against the politicking of what's going on is really where we're going to see where things end up. But I think there's a lot of bluster out there right now. I mean, take a state like Jersey. They tried to do something similar, and they passed something in law, but it has very little impact because they tried to limit it not only at the Medicaid dollars, but at the Medicare dollars. The association called out the state and said it's flat out illegal. You can't put any triggers in place that'll have caps on the Medicare dollars since they're federal dollars, and they lost. So while there are caps on the Medicaid dollars, since the Medicare dollars are really the profit centers of most nursing homes, you know, you can still make money in that state. So like Amy said, it's just about, it's no different than understanding a CMI system versus a cost-based system. They're going to put rules in there. I mean, even in Ohio, I heard rules that they're talking about not necessarily having minimum staffing like other states are doing, but to tag you on your rates, to penalize you on your rates if you don't have certain metrics. So people have to figure out, like, does it make sense to take the penalty and monetize it somewhere else in the facility, or does it make sense to be at those staffing levels and get the rate that they think that they deserve? And I think that the entrepreneurial and smart operators are going to be able to figure that out.
See, what was interesting is, like, someone my age will remember Y2K, where the computers were all going to turn off. Everybody figured out around that. We then had PDPM. Oh my God, that's not going to work. We're going to get killed. Everybody figured out around that, and I think people did very well there. I think in the same situation, Freddie, you're going to have the smarter people who use technology, who use relationships and partnerships in maybe managing care, managing lives, figure out a way to create value for their families. That's what this is about.
And for what it's worth, Freddie, I mean, I agree, but I'm going to go out on a limb on this one, and it's a disaster. I mean, to cap profits at 5%, it just doesn't make any sense. I think Amy hit the nail on the head, which is you're gonna have folks that want to come into the sector or in the business, that want to put capital in and want to make money, and so it's going to be counterintuitive. It's going to impact care. You're going to force people to spend money on nursing, which you should, and absolutely. And I think everybody in here knows that if you spend money on nursing, you have good outcomes and you have great results, and you send people home, then you make money, and it's what we do. And so when you make money, you have more money to put back in the physical plant, you have more money to put back and hire more nurses. And so when you cap folks, it's going to be a problem. And they're treating the industry from that perspective like a utility. It's not a utility. It's very specific in terms of the relationships. It's very specific in terms of the care we talked about. So you can't treat one nursing home in upstate New York as you can in the city and in Brooklyn, et cetera. So it's a disaster. And I don't think it's going to work. I think they're going to fight it in court, and they'll fix it.
When I was a kid, growing up in Chicago, there was like 3 nursing home owners or 5 nursing home owners, and the barrier of entry to get into a nursing home was if your father was in the nursing home business, you were able to be in the nursing home business. If not, you could be a CNA or work in the kitchen or be a maintenance director, but you can't own nursing homes. But thanks to the people on this panel, I really mean it seriously. Thank you to the people on this panel. People like Erik and Alan and Amy and Ari, who have allowed people whose parents were the maintenance director or a teacher or whatnot, break into this industry. I mean, it's really kudos to the people on this panel who've given a shot to young operators that they believed in and had no balance sheet, and had nothing really to show for themselves other than a big mouth, and help them, you know, break into a seemingly impenetrable industry. Question, the future. Where do you see that? Is it anybody who's in is in, and the newcomers are going to it's going to go back to that threshold of entry where it's just going to be too difficult for banks to look at a young guy who wants to break off and take his first building? Or do you see it being, you know, flowing 800 million style? Question.
I'll take the first. I'm going to quote Ralph, something that he probably forgot that he said about 8 years ago in one of the Monday meetings when they talk about kind of the State of the Union and getting caught up. He said that people were getting lax in following up with the second generation of real estate multifamily owners in the city because, you know, why should I speak to the kid if I've had a relationship with the dad or the old man for 20 years? And he said, you can never stop. You always have to be aggressive. This will be the next generation. They will take over these portfolios, and you just can't leave it to the wayside. And I think what has happened in the industry over the last 10 years is that it went to the wayside of being the old man's club, where you had to have been in the industry almost by accident for the last 30 years. And look how well every lender on this panel has done with the young newcomers. I mean, some of their best exposures, some of their best operators, some of their best borrowers are guys who started 5 years ago, 4 years ago, even 2 years ago. Because those guys have the aggressiveness, they want to make it work, and I almost think that the underwriting process, what the banks expect from the newcomers coming in, force the newcomers to be better operators because they have to prove themselves. How are you going to deal when you have a capital call issue? That's a good question. And if they don't have the right answer, they're not going to get financed. They don't just finance anyone just because they decided yesterday the guy was an administrator and today I'm going to be an owner. They have to impress the lenders. They have to come with a narrative that makes sense. And if it doesn't, they're just not going to get financed. So not only do I not see it changing, I see the future being on the young guys. And I tell my guys all the time, I mean, sometimes, thank God we've been blessed to have a lot of institutional clients and we've been growing, and sometimes we get well, it's a small deal, so you probably don't care. Like, our business was built off of backing the young newcomers, and we continue to see that to be the wave of the future while maintaining the relationships that we built so far. So I think it's going to be, onwards and forwards like it's been up until now.
I also think that the business has so many other businesses that come off of it, Fred, that gives these younger guys opportunity, whether it's in technology or staffing companies or home health. There's so many other things that come off of just a pure nursing home. Look at all the pharmacies that have started and the joint ventures, all the different little businesses that create opportunity for that, you said maintenance director, whatever it is. There's just not the nursing home anymore. You had, one food service company. Now there's hundreds. And that, I think, is the great thing about this industry, is that enables, you can help the next guy who can help the next guy who can help the next guy.
But Freddie, I want to answer your question. I mean, I think you wanted to know what's going to change in the future for the young guys, and I think the answer that I would have is absolutely nothing.
Exactly.
I find that, some of my operators who have been in the business a long time joke that it's a young man's business. And so sometimes they want to perhaps be getting out of it, but young folks have that grit, that drive. And so if you sit down and you talk to folks about what it is they've done in the past, what their experiences, what their growth plans are, how their capitalization has been structured, what access they do have to that capital, and you really get a good feeling about the people that you're talking to, that's what really makes a deal work. It has nothing to do with age or experience.
She's right.
All right, we asked this question by almost every panel, but I'm going to ask it again because a lot of people in this audience are looking to finance their deals, and they don't know where to turn. And obviously, it's easy to just call Ari because he's up here and is widely available, and you call Ari or Ralph or Ari Adlerstein, or anybody else from Meridian. But why would someone go to a broker when they can go direct with a lender and perhaps circumvent the 1% origination fee? And any other is. I mean, what's the upside? I mean, I'm trying to create some argument here on this panel here. But what's the upside of going through a broker, and what's the upside of going direct?
You should have had a borrower on the panel again this time.
I'll let Erik start.
Oh, thanks. Appreciate it. Actually, I think we had this conversation last year or the year before. So it was last year. It was the year before. Time. Clearly Ari and his team do tremendous work for the industry and for the sector. I think we touched on a little bit in terms of how they're able to help, in particular, maybe some smaller operators or new operators come into the space and how to think through underwriting, how to think through approach, et cetera. Clearly there's a value add there. In particular, again, to the extent that you're relatively new to the industry, and if you get the backing and the blessing of a Meridian, as an example, that's valuable when it comes to any of us. I would obviously note that there's clearly benefits to having direct relationship with the lender as well, and the benefits that can really provide. It's relationships at the end of the day, right? And it's longevity, and it's trust, and it's all the things that we all know that drive our business day in and day out. And so while an intermediary is good from a transaction perspective, absolutely, and pushes all of us to think through a deal better, I do think that there's clearly benefits as well of having that direct relationship and knowing that your lender's standing beside you and through thick and thin and through COVID and whatever else it may be.
Just a quick story about Erik. On March 19th of 2020, Erik called me before I called him. I mean, I was freaking out. But Erik gave me a call and said, Fred, don't pay your debt service this month. Took the initiative as a lender to say, hey, don't pay your mortgage. But then the next month, you took it. But I just...
with a late penalty.
Right. That's where you need a broker. Thank you.
Freddie,
I also told Freddie not to pay his debt service. He didn't listen to me.
Freddie, one other point on this broker, no broker. When you're running a building, there's a million moving parts. And not many organizations in the healthcare space, nursing homes specifically, have someone or an organization to pull it together to present it to the lenders. They don't have someone who can be after the lenders and to be pushing. So you as the owner are distracted from running the building. What Erik said is, you got to take care of the patients. So as lenders, it's understood that people will use the intermediary because you're busy taking care of your residents and taking care of those families. That's your job, your staff. And March 19th, your hair was on fire, whatever you had of it. Okay, and I want everybody to notice Fred's wearing sneakers. Next year, everybody comes in sneakers. Much more casual next year. So, but at the end of the day, Fred, you might not have the ability, and your best execution for your company, not necessarily 6 basis points less or more, might be bringing in someone like Ari to help you pull that together while you're running the building.
But could you make the argument, again, that when things go the other way, and there's an IJ in the building, and suddenly the docs read technical default and whatnot, and suddenly you got to call Ari to make the case why you shouldn't be that way, and maybe having that direct lender relationship can be an added value to you, Alan.
But I think as a borrower, yes, you bring in your intermediary to help you.
I mean, you told me the story with one of your operators putting you on a WhatsApp chat and saying that regionals are coming into the building. So
exactly.
This is a problem.
So the key is to communicate with your lender post-closing. Yes, the Meridians are important to enable you to transact, but then you have to stand on your own 2 feet. You're the operator. You need to have that relationship, like Erik said, the interpersonal relationship with the lender. So if you haven't, if the FBI's walking in the front door, you actually know who to call. Because honestly, Ari can't help you. It's not his job to do that. You should, as a borrower, step up and make that relationship more durable than just that one transaction.
But let's be clear, right? Ari's goal is to bring people together, and it may be Ari, it may be other folks who are less superior.
But then exit the scene.
But your job is to make that introduction, to get clients and borrowers together and lenders together, to get them to know one another, to help them negotiate the best deal possible, and then to make sure that you usher it through the process and that you're staying on top of the lender to make sure the lender's following through, that the borrower's getting what they need, and that ultimately it gets to closing. And I think that is one of the many benefits that having somebody like Ari, Adlerstein that is, involved in the process.
Does the broker have an opinion here, Freddie?
No. We all know the broker's opinion.
Well,
we all know Ralph's opinion.
Listen, the one thing I'll say is that if the suggestion is it's either or, then you're already mistaken, because I think that over the years we've learned from how certain advisors think about the relationships between a lender and a client, and and how, you know, we looked at the history of Meridian and how they've always interacted with their banks. And, you know, the big thing for us is that if we are not creating interpersonal close relationships between the lender and the borrower and facilitating that as part of our advisory work, then we didn't do our job. So, you know, if the lender feels compelled to call me up with an issue, it's not, I mean, we've gotten involved with these issues. Alan, we financed the portfolio in Florida. There were some significant IJ issues, and I was in the thick of it over there, and it was an added advisory work. And for anyone who doesn't completely do literally every single service in-house, from pharmacy to therapy, I mean, everyone has at least one vendor. You're not producing your own, you know, your own food manufacturing, you know. We're a service provider just like anyone else, and the question is, what is our service? And our service is exactly like Amy said, developing relationships. And part of that advisory work is working with the structuring and working with the underwriting and think of different ways to approach things. I mean, the advisory work that we're doing with clients many times is coming way before a lender package even goes out. It's about how do we approach this? Which facilities do you want to keep? Which facilities are not in your core areas that you should flip off? How much do you think we can get if we flip them off? All these types of things. So if the lender doesn't feel at the end of the process that they have that direct relationship, then personally we failed. And that's not our goal. Our goal is to have those direct relationships, and some of your closest relationships originated with us. And we love the fact that you have those direct relationships with the clients, and those clients still use us, and it works.
Just
and some of them call you. Some of them call you and just say, "I want you involved, and I want to use X lender."
Yeah, and I'm fine with that. You know, if that's what they want.
A lot of operators have asked me. They've been asking me about this, and the question is, are any of the banks providing any COVID relief programs that can help a struggling operator deal with, you know, a constrained cash flow issue during these times? You know, you have 2-3 buildings that are underwater, census at 40-30%. Any banks have any programs, any of the FinCos or, you know, conventional lenders that have like a COVID relief fund or anything? Amy?
I don't know about COVID relief fund per se. When the pandemic hit, the first thing we did, similar to, you know, Eric and I'm sure Alan, was call every single one of our borrowers and ask how they were, understand where they were with PPE, asked if they needed assistance in getting it, asked if they needed assistance with their debt service payments, if they needed over advances on the revolvers. Our goal was to work with all of our borrowers and make sure they had the access to whatever liquidity they needed. And that was very, very important to us. We then got very involved in the PPP program. We helped not only our clients, but I would say probably a lot of people in this room that we had never done business with. But our goal was just really to help anyone and everyone who needed our assistance, no questions asked. And we spent a lot of days and nights working very, very hard and developing systems to process as many as possible and save as many jobs as possible. So nothing more formal than those things, but we'll work with each one of our individual borrowers as they need.
Eric?
Yeah, we're working on a number of things. As many operators in the room are probably aware of HUD's operating loss program, the 223D. We've got a number of those that we're going through right now to be able to help operators get a year worth of debt service in place. We're also working with HUD on some other initiatives that to be able to mitigate equity requirements on some new development or additions. So we're working through that. From the bank perspective, you know, we are thinking about launching a program, a COVID occupancy relief type of a thing, where we'll provide operators with 6 months worth of medical supply payments and dietary payments as well, and make a corporate loan. So as occupancy continues to build over the next 3 to 6 to 12 months, to be able to provide some additional liquidity. So we're always trying to, you know, be creative and figure out ways to give our operator and borrowers some runway as they continue to battle through the business component of this.
About 2 years ago, I was sitting in UN Grill with Alan and Andrew on the upstairs room over there, and my partners, and you actually told me a very interesting fact, that in the last 10 years, over 2,000 nursing homes have been closed, and only 200 nursing homes were built. I don't know if that's still true.
It's nursing homes and adult homes. Nursing homes and adult homes.
Nursing homes and adult homes. So now the question is, we've been hearing about baby boomers, and we've been hearing about census coming back, and the fact that they've only constructed, whatever, 50 or 100 new nursing homes in the last 10 years, compiled with the fact that most people that were developing nursing homes in the last 2 years probably put the project on hold. And how do we, as lenders, not we, but you, as lenders, see census coming back? Will it come back to pre-pandemic levels? What are your thoughts on that? Will the baby boomer boom that we've been hearing about for the last 20 years, baby boomers are coming, baby boomers are coming, will the baby boomers ever come? Or maybe they just don't like nursing homes. Question.
I think that there's, I think that there are vintage facilities that the physical plant, no matter what amount of capex you put in, are going to have to be shut down. So I think that there's going to be a natural consolidation of census, generally speaking. I mean, I remember a story during Corona where one of my clients, at the very, very beginning, he had regular blue-collar guy come to his facility and pick up his 93-year-old mother because he was nervous about her health and getting exposed to Corona, and brought her home with him. 2 weeks later, he brings her back to the facility and says, I was up all night changing, doing medication, doing everything that would be done in a nursing home. I was up all night. I could not work the next day. And I think that, right now people have been putting Band-Aids on tough calls with family members, what they need to do in a facility. But I think as the biggest fear, and I think the biggest issue with census today was the fear of, do I want to put my loved one at the possibility of getting exposed when you know that they are the most at-risk population when it comes to this pandemic. And I think that as that perception falls off to the wayside, and the vaccinations have gotten out, I think census will come back, but I think it's going to take longer than what most people think, because no one was ever jumping by 20% census, even in the good years, right? So it's going to be a process until it comes back, but I think eventually it'll come back.
Alan? You're the one that made this prediction 2 years ago.
I think that what we're seeing is borrowers in the nursing space are looking at other options in housing, senior housing, assisted living, memory care, creating continuums, almost like an unconnected CCRC, so that you can offer people a scale. You don't want to go to a nursing home? I have this other product. And we see that there have been a lot of assisted living built over the last, let's say, 5 or 6 years that we think are going to take a lot of that initial years. I think the skilled nursing industry is just going to be more clinically complex. And I think you're going to see buildings that have triples and quads. I think you're going to see some regulatory there where people are going to be nervous in triples and quads. I think you're going to want to see more singles and doubles as people become more and more clinically complex. And Amy and I and Eric all believe that one day the baby boomers will come. And that's what we keep telling our group, that one day.
That's what you tell your investors. PACE, the PACE program, which is basically skilled nursing without walls, which is basically giving people money to care for their loved ones in a home-based setting. How will this impact the SNF landscape, and how the expanding home care, is that going to affect the SNF and the AL space from a lender's perspective? Amy?
Hard to say. I don't have a vision into the future. I think there are lots of... I don't.
Oh, okay.
There are lots of things that are impacting skilled nursing, right? I think first, we have to think about skilled nursing as a higher acuity setting that it used to be. It's not the facility of the past that was just room and board. So the types of people that are in facilities, as you well know, are not who were there 10, 15, 20 years ago. The number of nursing homes actually from the mid-90s when I got involved in this business to now has roughly, that was a nice joke, was roughly the same. I mean, it's been the same, rough 15,000 nursing homes in the country for this entire period of time. So yes, the baby boomers are coming, but they're not coming because they want to be there. They're coming because they need to be there. And PACE programs are actually, I think, a great benefit for certain communities. And you can probably run them alongside nursing homes or in conjunction with nursing homes. but I don't think they replace them.
I also think that technology is going to enable the government to see the outcomes. Is the PACE outcome better or is it worse? Should they be at home health or should they be in a skilled nursing facility? And I think it's going to take a few years to figure all this out because those outcomes track a year or two behind the actual care. So I think that this is a moving target for the industry.
Yeah, and I think that, as Alan and Amy noted, clearly there's a lot of what's perceived headline risk with respect to home health and home and community-based services. But as I think the panelists have noted, and the pandemic, amongst other things, really showed us is that the residents that are in our buildings really need that care. I mean, they are clinically complex. They just can't stay home. And so I think that from a bottom perspective, what unfortunately a lot of the operators experienced over the last handful of months is we saw what that number is. So to Ari's point on occupancy gains, I think there's tremendous pent-up demand that you're going to see both in seniors housing but also skilled. In the number of elective surgeries that have been on the sidelines. So I think we're going to see a pop as it relates to Medicare. But there was an interesting article I read that said, it was a really interesting perspective that said that as an industry we should welcome home health and home care because we can't deal with the demand that's coming without it. So I think it gets to Alan's point when we talked about the baby boomers. It's coming. And so without home health, and I know it sounds like an odd statement, but we'd have challenges dealing with all that demand.
I mean, for a sophisticated entrepreneurial operator, right, where are you taking the services of a PACE program or a traditional home health, and where in the life cycle of servicing a patient, where are they going to need that more? I mean, when I think of competition to home care directly, I think more of like an ALP or an AL Medicaid waiver program where there's some assistance going on and maybe not 24/7 care or to the degree that you see in a nursing home. And maybe as opposed to in the past where people's idea of a continuum is the traditional CCRC model, maybe the new continuum is having the diversification of having both home care PACE/PACE and the nursing home so that you're keeping them within the space and within the system. But as a standalone, like I think the challenge with the baby boomers conversation is that as nursing homes get more sophisticated in the level of cares that they're providing, and as assisted livings are newly built and people have arguably more lifestyle choices than they are care choices, the baby boomers are going to be staying healthier longer because, thank God we've technologically advanced and medically advanced that they're going to be living longer and healthier for more years. So I think traditionally where we think the baby boomers, they're hitting 65, what 65-year-old outside of a Medicare patient are you going to see in a nursing home setting today versus in the 1980s or the 1990s? So I think it's just a question of time. I mean, we have a client in the Bronx that his facility dropped to as low as the low 80% in the Bronx during Corona. He's back up to 93%. So the question is a location like the Bronx, is he filling up because it's just so urbanized, or is he filling up quicker because it's more urbanized? And is everyone else going to get there and it's just going to take longer? We don't know yet, but I don't think that home care is going to be able to completely replace the services and that the care services that are being provided for those patients.
One thing I will note, Freddie, and we haven't talked about it, but just really quickly is I think we'll be okay on the resident side. I think the $64,000 question and the industry grapples with all the time is going to be staffing. Yeah. So it's going to pull potential nurses and CNAs that would have been in our buildings and take them out of the building and in a different setting, which arguably could be perceived as better. And so that's the real issue that we're going to have to deal with as a sector over the next 3 to 5 to 7 years.
All right, one final subject before we wrap up here. HUD. Really have no guidance as to where HUD is going. In fact, the guidance is changing almost daily. And they're changing rules with how they're underwriting, and you speak to the people at HUD and they don't know the rules. And you have IGT and UPL, which is now coming down, being capped at a 14% value or 20% value, or depends which person you speak to that day. What do you suggest as far as a new transaction? Yes, obviously go to Ari, but new transaction, bridge, conventional, seeing a lot of the operators shift over to conventional. From a lender's perspective, a lot of these bridge products, you're paying more, and you might not get to the exit, especially now, and especially because you don't know how they're going to calculate COVID relief and how much money did you actually make or you didn't make, so you don't know if you're going to get to that exit. What do you suggest for the borrower, Amy?
Work with a lender who's flexible first and foremost. You know, we've created solutions that our borrowers are seeking. So if they want something more conventional, we're able to offer something more conventional. If they want bridge because we don't know what HUD's going to be in 3 years, then we'll do a bridge loan. We might have to reassess. Hard to say. I think Erik probably has the most insight as to what's going on with HUD, and that's probably not a whole lot. HUD is difficult to figure out. They provide a great product if you can get it, but it may not be the solution forever. So we'll continue to provide bridge loans for those who are seeking bridge loans. We'll continue to provide, you know, maybe something a little bit more conventional if that's what somebody desires. But I think HUD is not going away.
Our clients came to us with this decision, and so what we did is we created a 5, 7, and 10-year loan program with lots of flexibility of coming in and out. Because if it does open up and HUD then decides what they want to do, they want to be able to seek that really low-cost HUD execution. So what they want to do, though, is get off the bridge. The bridge is the most expensive. And they did what they said they were going to do. They got it, they bought it, they stabilized it, they've created good clinical outcomes. They want to be rewarded for that. So, but they just need a little bit of time, 3 years, 5 years, maybe it's 7 years, I have no idea. So we just sort of looked at it like Amy said, we just came up with products to meet the client's needs.
Erik?
You know, I think, 2 responses. I think for many borrowers in this room, we know HUD can be challenging and not the most expeditious program, but I think to their credit, you know, they were a great partner to the industry last year. They really stepped up when a number of folks here were in bridge programs with banks that aren't here anymore. And so I think HUD financed about $3.6 billion last year at phenomenally low rates. So, you know, I think that they tried to be as creative as they could, being a federal, you know, agency. I don't think the program's going away. I think they're going to continue to be a backdrop for the sector. I think they got very creative in terms of how they looked at valuation. I mean, how do you value an asset in the middle of a crisis? You can't. And so, you know, we tried to help them to think through that as well. To Amy's point, though, in terms of what you do on the front end and in the interim, and if you think HUD may go away, you have to work with a lender who's been in the space and who's not going anywhere. I think, unfortunately, we saw it this year. We saw it in the financial crisis. Lenders were in and out of this space. And so you want to be with a lender who's been there for 30, 40 years, through thick and thin, through ups and downs. Supports the sector. You want to be with that in good times and bad.
I think what's becoming clearer, based on what's happening today, I mean, for years, every HUD lender would tell you how great they are at HUD, and the answer would kind of be, well, HUD's a box, right? And I think what we're coming to learn is that the people that really understand the HUD system and have the good relationships internally, yes, to a certain extent, it is a boxy type of product, but there's also a human aspect to it. There's talking to someone on the other line. So I think that we're personally noticing some of those HUD lenders with stronger relationships and willing to push harder and be more aggressive are really coming through for their clients where, frankly, other HUD lenders might fail. So I think it starts becoming more important to think who's going to be representing you on the back end of your bridge loans. We've also been a lot more cognizant of, you know, it's great to have the products out in the market, you know, 5, 7, 10-year programs. We've taken advantage of them. I mean, it's a lot of the upside that we provide to our clients, that we're not just, you know, have a HUD execution on the back end and we can think outside the box. But at the end of the day, HUD's a product that's going to stick around. They're going to figure it out. Things are going to start stabilizing, and you might just need more time. Don't take a 2-year deal with no extension options. That's just irresponsible in today's environment because you don't know what's going to happen with HUD. But make sure you're structuring your deals in a way that you have that flexibility on the back end.
Anybody from the audience has a question? Ralph? Nothing? Huh?
Great, thank you, Ari, thank you. But it's always really a great panel. Good to see everyone.
If I could just say one thing, you know, obviously the industry has gotten a very, very bad rap with politicians going after the industry. I have personally, as well as everyone up here, have seen operators go above and beyond the call of duty to provide for their residents and help each other. I mean, I have clients that bought hundreds of thousands of dollars worth of ventilators, and when they were done with them and a different operator did them, they literally just gave it to them or gave them to hospitals that they had relationships with. And I think that those stories sometimes go missed in the papers and in the media sometimes, but I think pretty much everyone here has been great to their residents. Obviously we talk about the financial aspect of it, but there is a care aspect, and all the good operators, if you're doing financially well, it's because you're caring well as well. It just goes hand in hand, and we appreciate and we recognize what you guys have done to do the best through a very, very tough situation.